Can you hear me now?
I can, Jim. How are you?
Outstanding. I am great. Thank you.
Did you call in?
I'm in the Zoom.
Okay, but you called the Zoom,
No,
right?
I didn't call, I don't think.
Okay. Let's see if I can get you to share your screen, because I wasn't able to promote you to a panelist. Why don't you try and share the screen?
Hang on here. It said.
Oh, now you're coming in as a panelist. Okay. I think Blake did it. All right.
Can you hear me now?
Got you.
And I think I'm a panelist. Yeah.
Yeah, now you are.
Outstanding.
You want to share your screen?
Sure.
It's a green box.
Yep.
And great time to have you on, I think. As we, and I know that you're joking as far as, what are you going to say? And yeah, you're a regular now. All your friends are asking you if you made the cut. You made the cut. So,
so let me try to share my screen and get some stuff up here.
Okay, there's your Twitter stream.
Give me a second. Okay.
The VIX on the DSI sentiment was a single digits last week, Jim, 9 on a sentiment service survey that we use.
All right, you see my my slide here?
No, I'm still seeing Twitter, so you'll probably have to do stop sharing and then new share.
Okay, hold on a second. What's going on? It's weird because I'm seeing it on mine.
Yeah. So why don't you just hit the stop sharing, and then hit the screen share again and pick the screen that your slides are on.
Which is what I thought I did. That's weird. Now I'm having trouble getting back to the Zoom. Why is that? Where is that going?
Well, let me do this.
Hang on.
There you go. You got it now.
Now let me try again. Sorry for the technical
I don't know
difficulties.
about this regular. You got some ground to make up now.
I'm always screwing something up, Dale.
Hey, that's life. It's how you rebound or adjust to your screw up. So
why is
something? There you go. I see the red boxes and your slides.
Okay, perfect.
Okay, so
let me try to turn that into a slideshow.
Okay.
Yeah, so I was last with you in April.
Yeah.
Right.
Yeah.
And what we've seen since then in VIX land is really, and I'm not a huge fan of technical analysis on the VIX, because it's not tradable. There's no supply demand characteristics. But the reality is that the market has said we're less and less nervous as time has passed, at least until now. We've had a series of when the VIX has spiked, as it is wont to do. We've had a series of lower highs with those spikes. And the bottoms, have tended to be moving lower, right? We had just come out of that post-pandemic period where the VIX was stuck above 20 when you and I last talked. And we've now settled firmly below 20 in terms of the bulk of the moves. We've had a few spikes above 20, but we seem to be settling down. Fear seems to be subsiding more broadly, even though, we've got the Delta variant, we've got Fed policy, inflation worries, and now we've got Afghanistan trying to pretend it's Saigon all over again. But generally things have just kind of settled down and gone sideways. I think did I switch slides on you?
Yes.
Excellent. Okay. So, looking back, similarly, obviously the S&P 500 has continued to notch new highs. And this is just another sort of peek using a 50-day moving average of the VIX index that shows that we've just kind of slowly receded. Fear has been ebbing out of the market. And as you guys were discussing, the $64,000 question is whether that subsiding of fear is appropriate given some of the potential headwinds we're facing. But,
right.
It kind of is what it is. Looking back, when we were talking in April, looking at the SIBO volatility term structure ranging from 9 days to a year.
Yeah.
Since then, the short end, here's the beginning of the interesting stuff. The short end has clearly dropped, but you go out to 3, 6 months and a year, and we really haven't come in that much. So the front end, whether it's using the SIBO term structure, I'll show the VIX futures in a second, the front end has come down, but the back end has stayed high. We've really steepened the front end of the volatility term structure. And taking that SIBO term structure and looking at one of the relationships, this is the relationship between VIX 30 days and VIX 3 months, which stock charts still uses VXV, the old nomenclature. But, this shows how that relationship, the lower the chart on the bottom goes, the steeper that relationship between 30-day volatility and 3-month volatility is. And you can see that currently we're at very steep levels, very low levels for that ratio. And, I'm not going to say that indicates that the market's at a high and we're going to turn around, but it just tells you that conditions are stretched. It's tough to get, it's tough to get that relationship to be steeper. And generally, when the term structure flattens, it's not a good thing for equities.
Okay, so we go from steepening to flattening to backwardation would be the next step to where
backwardation would be the next step. We haven't seen that in so long that it's hard to remember what it looks like.
I mean, are they going to ring a bell and give us backwardation on the first break from whenever a major high comes in, or does that happen after the first break? They start pricing that in, or the term structure shifts?
Yeah, in my experience, and everybody says, you never want to be naked short volatility because you could wake up the next day and find out that you're dead.
Broke. Yeah.
And while that is theoretically true, my experience is that that's not usually what happens. And let's just take this chart and go back to the start of the pandemic, right?
Yeah.
Let me see if I can. Yeah, here we go. So, you made these. The term structure was really steep back at the end of 2019, right? And then what you saw was it started flattening. As this line moves up, it means that the term structure is flattening.
Right.
And at the end of January, you had, that little pullback, which then everybody said, oh, never mind, everything's okay. And we marched back to new highs. And the term structure, again, began to steepen a little bit, but it never got back nearly as flat as it was before.
Yeah.
So, if you were short volatility going into the pandemic, you weren't paying close attention. At a minimum, you had to be hedged. And, that's just one observation from this.
Okay. So you're getting the first signs that at least now you wouldn't be short volatility now that we're compressed like we are right now.
Well, it's one of those conditions where you need to be thinking really hard about why you might be positioned. And again, as we talked about on the last show, there are 1,000 ways to be short volatility. There aren't that many ways realistically to be long volatility without bleeding to death. But you do need to be asking yourself.
What's the best way where it's only It's only a cut and not a hemorrhage.
Well, there and I am not your options expert. I hang around with a lot of people who, are pretty sophisticated in how they can put themselves into a position where they've got some long volatility exposure while minimizing the bleed. It's not easy. And, it's one of those things where timing can be everything, because you don't want to spend your whole life being long volatility.
No.
It's just not going to pay off. And, so I think any way you look at it, I would argue that there's an element of timing that is useful. To be
Yes.
long vol all the time is not, to me, is not a smart way to play it.
Okay.
There've been a lot of studies done on hedging portfolios. AQR did one that's been widely read, looking at hedging portfolios with index puts, and how it really just is not very efficient. But it's one of the big product innovations of the last couple of years are exchange traded funds that offer downside protection. I mean, it's like hotcakes. They are selling fast and furious. And, I think every investor who's paying attention has concerns that some of these all-time highs can be taken out of their portfolios in relatively short order. So everybody's looking for the answer. And the truth is that, there's no free lunch trying to hedge a portfolio or go long volatility.
Yeah, in fact, what the sentiment and what I'm getting is that people are saying, why should I hedge? It's a waste of money. And they've been right since the lows of the COVID crash. And but you don't buy fire insurance for your house hoping there's going to be a fire.
No, you
right?
don't. And I think one of the
So I think
challenges
most are
work,
unhedged and heavily margined. What do
I
you
work
think?
with a lot of smart people who hire me as an advisor because this is not what they do. They're
Right.
really good at what they do and they need some help on the investing side. The biggest challenge I find is people sticking to a strategy when markets get a little wiggy. We can look back now and it's easy to look back and say, hey, that whole COVID thing was kind of a non-event at the end of the day. All you had to do was hunker down and stick to your program and it all worked out. But, the first week of, or the second week of March 2020, a lot of people were deeply concerned that, this was going to be ugly on a sustained basis. And getting people comfortable that the strategy they have is going to accomplish their objectives, and is something that they can stick with through the easy times and the tough times is the big challenge. And that's why some people feel comfortable having a hedge in their portfolio, even if they know that it's not necessarily optimal from a return standpoint. It helps them sleep at night. It helps them stick with their strategy. And at the end of the day, that probably is the right decision to make.
Okay, I know you're a little hesitant, but let's just say for yourself then, you're not recommending it for anyone. What would be your way of hedging a market that has become parabolic and stretched like this?
So,
for you, Jim.
look, yeah, I am a volatility guy, and I use the exchange traded products that are out there. I'm working with some folks I know to try and introduce some new ones, and we've been hoping for a while. It's kind of roadblocked at the SEC, but I will from time to time take a position long volatility through the exchange traded products as a way to hedge a portfolio. That can be VXX, could be UVXY, used to be TVIX, rest in peace. On the short side, it used to be XIV, F.A.C.E, is available now. And those are tools that I will use, but systematically and again with some element of timing, to give myself and some of my clients exposure either on the short side or the long side of volatility.
Okay. And when you are implementing this, you know, I mean, we've been in an ongoing bull market, so there's not even any perception of anything but, like, you addressed COVID, which was, I don't know, what, 30-40% decline that happened in a few weeks and disappeared in a few months.
Right.
What's the average hold time for anyone that you would advise? And what if we end up having some type, instead of being a crash this time, we end up having, you know, a garden variety bear market that, you know, can last, you know, 6 to 12 months and not just be kind of like a flash crash and it's over. Is there a way to, you know, position yourself, or do you always have to be a trader when you're using these things?
You know, to me, if you're using, and again, most of the people that I know who play in this space are traders. They don't view themselves as long-term investors, although there are some long volatility funds that tend to stay long volatility, and may, you know, during a crash period, monetize some of their gains to reinvest. But most of the people I know who work this space are traders. They have some systematic approach, either in the options markets, the futures markets. You know, obviously being short equities is long volatility. And, you know, I know people who use the inverse equity ETFs as a way to express a long volatility position, right? If you know the S&P is going down 10% in the next 3 weeks, you know, you buy the triple inverse, and you can have fun. You can also get your face ripped off.
There's an interesting question. I don't know if he's a follower of yours, from Lincoln, Washington. You know, he was saying, Jim, be interesting to hear you talk about the more than normal spread between VIX and VX1, VX2 that's close to VIXpiration, how that normally runs, and how that compares to the last 2 days and tomorrow.
So let's do that.
See, you know, I mean, when you need something to talk about, there's always someone with a good question.
So quickly, you know, again, drawing the contrast between the last time we talked and today, it's interesting that the VIX futures term structure, you know, is not dramatically different. And again, interestingly, you can see that the back end is anchored at a relatively high level, still right around 24. The front end has come down and it's relatively steep. I posted this to Twitter. You know, this was a close on Friday. And the front month future, which expires Wednesday morning, was at 1670 against a 1545 VIX. Obviously, VIX has popped up today. So it looks like the futures guys had it right. But that spread of 1.25 points with 3 days to expiration was, you know, call it 3 times the normal spread with 3 days to expiration. So, and the spread between the second month and spot was, you know, again, sort of 3x what you would expect with 3 days to expire for the front month. So the spreads, the front end has been very steep. The spreads have been very wide.
No one wants to give them away.
No one wants to give them away. And so the bet is on, right? Because if you think that VIX is going to stay in the 15s until expiration Wednesday morning, then you want to sell that front end future. And I think part of the reason that the term structure has been as steep as it is because there have been people selling that front end against a declining VIX because that looked like a reasonable probability to make some money. Today has kind of shaken it up a little bit. We'll see what happens. I'm a little bit, you guys were talking about it a bit before, the situation in Afghanistan, to me, was pretty predictable the end of last week. I mean, it's not like Kabul wasn't going to fall. So it always kind of amuses me to see the future selling off on this quote unquote news, which to me, I don't know how is this news?
Well,
but
I mean, just the process it's in. Charles Northamer is saying it was predictable a month ago,
right?
What was going to happen there. We don't have a lot of time left, but I'd like your opinion. If I could just share my screen, unless there was another.
No,
slide.
I'm done.
Oh, really? Okay. I want to ask you this, since you trade the VIX, okay?
You need me to give you the screen back, or can
no,
you
I
take
got it. It's coming to me. So here we go. So I want to ask you about this, because it was something I was noticing for quite a while. It was back, maybe it was here. Okay, you see all the way to the left in here?
Yes.
Where I had my cursor?
Yes.
You see these wicks?
Yes.
And if I go to the left, there were more of them?
Yes.
Okay, where it would open down here. Did anything really ever trade when these prices were showing up? And to you, who watches the VIX a lot more than I do, did this smack of accumulation, that they would try and take it down near the opening, but probably hardly even traded down here before the candle closed? I know this is a 4-hour, but we were even having these kind of wicks on a 15-minute TF.
Yeah. So again, everybody has to remember that you can't buy or sell the VIX index. So the VIX index is calculated from the values of S&P 500 index options, and you can go back and in with an extended hours chart, see those wicks fairly regularly, typically at about 8:30 Eastern time, so pre the market opening. And I've quizzed any number of people, what the heck is going on? What is this? And the best answer I've gotten, and I don't know if it's the right answer, is that you've got market makers essentially resetting their bid ask in these S&P put structures. And so you sort of have a little flicker. I hit the reset button,
right?
and for an instant, it pulled my bids and offers from the market, and so the market said, "Hey, wait a minute! Nobody wants these things. VIX has to go down." So, as best I can tell from people that I've talked to, it's one of these strange little anomalies. And again, VIX is not something that trades. It's quoted, but it doesn't trade.
Okay. So what's the best way for people to follow you and learn more about the VIX, Jim? On Twitter, or do you have a website?
Twitter's the best place.
At VIXologist. Yes.
And I am I do advise private clients from the Toroso platform, TOROSOINV.com, and happy to engage. DMs are open. Just don't hate me too much.
All right. Well, Jim, thanks so much.
You're welcome, Dale.
Yeah, I really appreciate you being here, because it's a lot of this is foreign to me, and if it is to me, I'm sure there are a lot of people that got some clarity today with some of the slides that you showed. I appreciate your giving nature to come in here and share your hard work with us.
Well, I'm happy to do it, Dale, anytime.
All right, everyone. So that's going to be a wrap. We'll see everyone for Turnaround Tuesday. Jim Carroll, thank you very much for being with us today. Follow Jim on Twitter at VIXologist. For anyone, I think people are going to start paying more attention to the VIX in the next 30 days. And Jim would be a great intelligence gathering source for you. And that's a wrap. Remember, don't just count your volatility, count your blessings. And we'll talk to everyone tomorrow. Adios, good hunting. And you could join the crew in 14 minutes on Morning Edge. And that's going to be a wrap. See everyone tomorrow. Thank you. See you, Jim.
Thanks, Dale.
Adios.